The yield curve is super inverted right now. And it's a very worrying sign because a yield curve inversion of this magnitude signals a brutal recession is on the way. At least it has previously. And there's a lot of talk about a soft landing. Maybe the Fed will pull off the near impossible. Maybe not. And I want to discuss that with you today, what the implications for this are and what it could mean for markets. Before we get into that, quick reminder, leave a thumbs up on this video if you do like this kind of content. And of course, if you are new around here, make sure to subscribe to the channel so you know when I put out a new video. Now, here's the chart. It's been getting a lot of traction on social media recently. So the last 4 times that the 10-year Treasury note inverted with the 3-month, it led to the 1990s recession. It led to the dot-com bust. It led to the global financial crisis and the 2020 recession. Now, to be clear, this doesn't cause that, right? There's other stuff that happens, but this is the canary in the coal mine that says, hey, things are kind of messed up in markets right now, and it's a warning sign. It's a sign that a recession is very likely imminent. And although technically the United States had a recession in Q1, Q2 of 2022, we kind of ignore that because the reality is that there's now a small group of people who decide when there is or is not a recession. They basically said, this is not the recession you're looking for. Now, does that mean we're living in a time where things have just changed? Yeah, this indicator's flashing. Yeah, historically it does mean that. However, now we have banks printing all this money. Now we've changed the definition of a recession, et cetera, et cetera, et cetera. Maybe none of this stuff matters as much as it used to. Maybe. I got more thoughts on that in a moment. We'd like to point out here, too, the yield curve inversion has hit a historical record here. Thanks to @BarChart over here on X for sharing the chart with us. The yield curve has been inverted for 210 trading days, the longest stretch of time in history. That's pretty gosh darn interesting. Now, does that mean the recession is more definitively going to come? Does it mean it's going to be a harder recession when it comes? This is the new Great Depression we're looking at. This is going to be worse than the 1930s. Repent now. There'll be gnashing of teeth and pulling of hair, and it'll be truly apocalyptic. No, not necessarily. We may have that kind of market one of these days, but this does not necessarily mean that that's going to be the case. Now let's dive in on what an inverted yield curve really is here for those of you who might want a little more information on it. So an inverted yield curve occurs when the short-term debt instruments have higher yields than long-term debt instruments of the same credit risk profile. An inverted yield curve is unusual, reflects the bond investors' expectations for a decline in longer-term interest rates typically associated with recessions. The inversions suggest that while investors expect higher short-term rates, there may be growing uncertainty or nervousness about the Federal Reserve's ability to control inflation without significantly hurting growth. The Fed has raised interest rates in this cycle up to almost 5.5%. So they can also look at the 2 and 10 year. It's also a very popular way to look at this. So the 2 and 10 year yield curve has inverted 6 to 24 months before each recession since 1955. That's according to a 2018 report by researchers at the San Francisco Federal Reserve. It offered a false signal just once. Now that's statistically significant because there hasn't been that many of them. However, there is one time when it has been a false signal. So it has been a false signal before. That research focused on the part of the curve between the 1 and 10 year yields. Global investment strategist for Commonwealth Financial Network found that the 2 and 10 year spread has inverted 28 times since 1900, and 22 of these instances a recession followed. Again, very interesting because we will be told time and time again that this is an infallible metric. Once you get the yield curve inversion, 100% recession's coming. But not all the time. Not all the time. Right? So since 1955, there's been one example when it hasn't. Since 1900. There have been 6 examples when it hasn't, although it's got a pretty damn good hit rate. Let's put it that way. So if you were betting just on this, you would probably bet in favor of recession, because the statistics support that most of the time there's going to be a recession when this happens. It goes on. For the last 6 recessions, a recession on average began 6 to 36 months after the curve inverted. Before this year, the last time the 210 part of the curve inverted was in 2019. The following year, the United States entered a recession caused by the pandemic. What's that mean for the real world? When short-term rates increase, U.S. banks raise benchmark rates for a wide range of consumer and commercial loans, including small business loans and credit cards, making borrowing more costly for consumers. Mortgage rates also rise. When the yield curve steepens, banks can borrow at lower rates and lend at higher rates. When the yield curve is flatter, the margins are squeezed, which may deter lending. Here's a quote for you. The 4 most expensive words in the English language are "this time is different." It's from the legendary investor John Templeton. Now, this is a very important line, because basically what it means is that usually this time is not different, because there's a factor in investing that tends not to change, and that's you, me, and all the other investors. Human psychology tends to get us in similar situations, which is part of the reason why we have market cycles in the first place. Yeah, the economic factors all come in, obviously, but who's in charge of all that economic crap? People. The Federal Reserve's not, well, I'm not actually completely convinced that the Federal Reserve is not some kind of actual monster entity from the depths of Hades. However, from what we know, it is a building where humans work and they make decisions that have relatively predictable results. That's worth noting, I think, in our conversation here. I'd like to point out this chart here too, shared by Game of Trades. The current yield inversion is at the same level as the 1928 yield inversion. Now, why is 1928 a significant year? 1928, that's when, well, the stock market crash started coming in. That led to the Great Depression in the 1930s. Stocks dropped 80% or something like that. It got pretty obscene, to be honest. And you might think, whoa, a 1928 comparison, that's scary. I mean, 2008 comparisons are scary. And this is the worst since 2008. Yeah, it's problematic because 2008 was pretty bad. If you compare us back to the late 1920s or early 1930s, also very, very bad for a variety of reasons to be compared to those. However, what's interesting with that chart that I just shared with you in particular is that, yes, same level as 1928, but guess what? It was worse in 1974, and it was worse in the early 1980s. We had deeper yield curve inversions. Now, do you remember the Great Depression of the 1980s to the 1970s, when everything ended and unemployment rates soared to 25%? And no, because it didn't happen. Now, were there recessions? Yes. In the 1980s, when that yield curve inversion happened, we saw the S&P 500 drop by about 25%. Technical bear market. We've already seen the S&P 500 drop by over 20% during this market cycle, which was a technical bear market. We've now exited that technical bear market. We could go back into that technical bear market. But just because you have something at the same level as 1928 doesn't mean you're going to have a repeat of 1928. That's not how it works. Still, though, significant and interesting to mention, but then disproven by the 70s and the 80s. So you have to look at the bigger picture here when you're trying to digest some of this information. Now, before we get into the rest of the story here, I just wanted to mention very quickly for you Wealth Mastery. So if you are a cryptocurrency investor, you have got to get this checked out. This is Wealth Mastery. This is the best damn newsletter in the cryptocurrency space. Every single issue, we are just providing super value for investors. Lots of alpha in every single issue. We cover the news, Bitcoin, Ethereum, the big coins. We talk about altcoin alpha, DeFi, NFTs, tutorials, technical analysis, and much, much more. You can join our 75,000 weekly readers by using the link down below to get signed up. Thank you. Now, Let's check this out here. This is shared by Kelly Evans. For the yield curve deniers out there today, she says, the average lag from a 10-1 conversion to a recession is 14 months, but can be as long as 21 months. So, executive summary. We have done a 7-decade study of the yield curve and how it relates to the business cycle and equity market performance. First, our work shows that inversions using the 10-1 spread have preceded recessions by 7 to 25 months with an average lag of 14 months. Moreover, half of the recessions over the last 7 decades, meaning 5 out of 10, featured a lag of 1 year or longer. Since we are currently 13 months into the inversion, it's woefully premature to assume the yield curve has given a false signal and the fabled soft landing is in the bag. Second, positive inversion equity market rallies are not uncommon, especially as growth slows and a soft landing appears to be unfolding. On average, equity markets tend to rally double digits in the immediate aftermath of an inversion. Critically, however, in nearly 7 decades, there has never been a post-inversion equity rally that was not completely reversed going into a subsequent recession and bear market. When, of course, we did not avoid that, as has happened sometimes, as we mentioned before. A look back through financial news pages shows that soft landing stories were common and the yield curve signal was dismissed going into the 1991, the 2001, the 2007, 2008, and the 2020 recessions. It's always different this time until it's not. So again, it's a very important indicator to be looking at. And while we have a lot of people continue to call for that soft landing, and statistically, it is possible to get a soft landing. I want to reiterate that. So a soft landing is possible. It's just rare and difficult. So this is something to keep in mind. Financial risks for consumers to watch out for. The job market, mostly strong. So the U.S. would have already fallen into a recession if not for a strong job market, which is pretty interesting. Job market has remained pretty resilient. Yeah, unemployment did go up last month, but still unemployment's at like lowest levels since the 1960s, which is, I think, important to note here, isn't it? The job market is less strong compared to the earlier part of the year, but still fairly robust given our current economic cycle. While many workers are changing jobs more in the past 12 months, the opportunities have cooled off a little bit as we see bankruptcies and stuff, of course, on the rise, as we covered previously. Inflation will take time to subside. It may take more than 12 months for inflation to subside. According to 43% of the respondents in this survey, just 7% said the pace of price growth will go down by this fall. People are generally in agreement that the inflation rate has come down significantly and is likely to continue to go down, but maybe the speed at which it goes down is not what you would expect. So we've seen inflation going up, and as inflation continues to go up, it'll put more pressure back on the Federal Reserve to keep interest rates higher for longer, and of course it puts more pressure on the average person who's already struggling to make ends meet. So you gotta think about that. And of course, as mentioned, interest rates may stay elevated for longer. Federal Reserve July rate hike took benchmark borrowing costs to the highest levels in more than 22 years. Experts predict those rates will stay high and could go higher to curb inflation. So if we see a spike in inflation, which is basically what we have been seeing, then we should expect higher longer for the rates, which creates more economic problems because it makes it harder for lenders, and lenders tighten up their lending restrictions, harder for borrowers, the rates are higher, corporate refinancing faces a lot of issues in that situation, and it's just basically problematic for, well, basically everybody in that scenario. And one final note here for you. No bear market has ever bottomed before the recession started. So if there is still going to be a recession, and there's a possibility that they may nail the soft landing, there may not be a recession, but if there is still going to be a recession, then the stock market has not bottomed yet. And that is worrying for anybody in risk assets. Now, let me know if you think that we have bottomed and we're going to get the soft landing, or are we still in for more economic pain? Let me know down below in the comment section. Thanks for watching today's video, and I'll see you next time.